Moving on to analysis of dividends and share repurchases. Now, companies offer dividends in two forms, either a cash dividend or a stock dividend. Now, the cash dividend is simple to understand. Company just pays out to their shareholders in the form of cash. Now, the stock dividend is something which is just a recalibration of shares, and it really does not impact the shareholders that materially. It's similar to stock splits and reverse stock splits. The other way in which companies can give back to their shareholders in a meaningful way is share repurchases. So when companies buy back their share from shareholders, obviously they will be paying out from their earnings. So companies can offer dividends in essentially three ways. One of them, stock dividend, is actually not meaningful. Cash dividend is self-evident. What does it mean? And share repurchase or stock buyback is something which is an indirect way to pay to the shareholders out of the earnings of the company. If we look at the discussion of valuation versus dividend policy, there are three ways to look at it. If I go by the Modigliani and Miller approach, according to them, dividend policy has no role in valuation. Second, if I go by the bird in hand argument, the idea here is that a cash which you pay back to the shareholder reduces the uncertainty in the minds of shareholder, reduces the cost of equity, and hence it increases the share value. And there is also a tax argument. In some geographies, dividends are taxed more. So in such cases, companies either can reinvest their earnings into future growth possibilities or buy back shares or do share repurchases. And yes, do read up the discussion on signaling effect of dividends and agency issues. Then there are two dividend payout policy. One is the constant dividend payout ratio and the other is the stable dividend policy. The constant dividend payout ratio essentially is dependent on the income. If you have more income, you give more to shareholders, and if you have less income, less gets out to shareholders. If I go to the stable dividend policy, generally the dividend stays very flat. Now in that situation, let's say company tries to move towards a target payout ratio, then in that situation what happens is they gradually adjust their dividends as per their income using a formula which has an adjustment factor depending upon how much time they want to give to move towards the target payout ratio, and you also have to adjust for increase in earnings and what was the previous level of dividends. And also don't forget to look out for subtle aspects of share repurchases and dividends in the CFA curriculum.